wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets, and we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 223, and in this episode we're reviewing the performance of the financial markets during the 30th week of 2026, and that is from Monday the 27th to Friday the 31st of July. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the Federal Reserve on Wednesday voted to keep its key policy rate on hold, but not without opposition from three officials who have expressed concern over inflation and the need to hike interest rates. Despite increasing support for a rate hike, the Federal Open Market Committee voted 9-3 to leave the Fed funds rate in a range of between 3.5% to 3.75%. The post-meeting statement noted that the three dissenters preferred to raise the Fed funds rate by a 0.25 percentage point, expressing the need for higher rates to address inflation that has been above the Fed's 2% target rate for more than 5 years. The Federal Reserve officials who voted to hike interest rates said that they favor hiking now in order to prevent inflation from becoming sticky, which makes it more challenging and costly to bring back down. Staying stateside, the Commerce Department reported on Thursday that U.S. economic growth was weaker than expected in the second quarter of 2026, though underlying drivers remained solid. At the same time, inflation in the month of June continued to hold well above the Federal Reserve's 2% target rate and complicated the central bank's policy path going forward. According to the Bureau of Economic Analysis, the gross domestic product for the U.S. economy, which is a broad measure of the value of goods and services produced within the country, this increased by just 1.5% in the second quarter of this year. Economists surveyed by Dow Jones had projected a growth rate of 1.8% in the second quarter, following an increase of 2.1% in the first quarter of 2026. The slowdown in the U.S. economy was mainly attributed to the decline in federal government spending and inventories. And in a separate report, the Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred measure for inflation, this declined from 4.1% in May down to an annual rate of 3.7% in June, which was in line with market expectations. However, excluding food and energy prices, core inflation posted an annual increase of 3.3%. The inflation numbers accelerated after the US and Israel attacked Iran in late February, setting off a surge in energy prices that are now crossing over into the broader economy. For your information, the Fed uses the headline PCE inflation number as its gauge for setting policy, but considers core inflation as a better indicator of longer-term inflation trends. Over to the Eurozone, where the Eurozone economy grew faster than expected in the second quarter of 2026 as surging investments in artificial intelligence, strong government spending, and several one-off factors more than offset a drag from the war in Iran and the subsequent increase in energy prices. Data from Eurostat showed that the Eurozone economy expanded by 0.4% in the second quarter, which was above modest expectations of a Reuters poll that had forecast growth of just 0.2%, but was way below the growth of 1% that was recorded for the same quarter last year. The second quarter was initially expected to be the start of a rebound after a difficult and turbulent year for the Eurozone. But soaring energy costs sapped much of the momentum, and most forecasters now see full-year growth of less than 1% in 2026. Although growth was better than forecast in the second quarter, it remains weak and stands in stark contrast to the continuing boom in the United States, which will likely see its economy grow by more than 2% in 2026, fueled in part by private sector spending on artificial intelligence. Over to the Far East, where the Bank of Japan kept its policy rate steady on Friday as it warned that core inflation could exceed its 2% target rate. Japan's central bank voted in an 8-1 decision to keep its policy rate on hold at 1%, with one board member proposing a rate hike to 1.25%. Meanwhile, Japan's core inflation for July came in at 1.6% and has been below the 2% level for most of 2026. However, in its outlook, the Bank of Japan said that core inflation was likely to accelerate to a level above 2% in the second half of this year. The central bank cited wage increases being passed along into consumer prices and the rise in crude oil, plus the recent depreciation of the Japanese yen. In the United Kingdom, in a move that was widely anticipated, the Bank of England on Thursday voted to keep its benchmark policy rate on hold for a fifth consecutive meeting. The hold in rates had been widely anticipated after headline inflation in the UK fell to 2.6% in the month of June. The central bank's rate-setting monetary policy committee voted by a 6-3 margin to keep the bank rate unchanged at 3.75%. 6 policymakers voted for the hold, while 3 voted for a hike of 25 basis points, which is a slight shift from the previous meeting where the vote had come out at 7-2. Although most analysts expect the policy rate to remain unchanged for the foreseeable future, the bank's policymakers acknowledge the upside risk to inflation and confirm they stand ready to act depending on how deep and for how long the conflict in the Middle East will persist. On Wall Street last week, the major averages were markedly high on Friday, which was the last trading session in July, as investors looked past rising bond yields. The bond market disagreed with the Fed's decision to hold its policy rate stable as the yield on the 30-year Treasury bond spiked to around 5.25%, which was its highest level since 2007. The spike in yields came as investors appeared to lose faith in the Federal Reserve Chairman's verbal commitment to bring inflation under control. Despite the week's sharp swings, the major averages remained on track to finish higher as the Dow, along with the S&P 500, were both up by about 1% for the week, whilst the Nasdaq Composite climbed by about 1.6%. On Friday, the Nasdaq Composite rose 1% to end at 25,373, whilst the S&P 500 added 0.7% to close at 7,489, and the Dow Jones Industrial Average gained by 276 points to settle at 52,485. In the U.S. bond market, U.S. Treasury yields surged on Friday following oil prices higher amid signs that the U.S. Federal Reserve could hike interest rates at its next policy meeting in September as a threat to global oil supplies persist. The rise in yields came after some Fed officials said that they favor raising interest rates in order to pull back on inflation. These are the same Fed officials who earlier in the week had voted against the central bank's decision to keep its policy rate on hold. Additionally, escalating tensions in the Middle East continue to push up energy prices and worsens the outlook for inflation, which in turn dampens sentiment towards bonds as higher yields push down bond prices. In response, the yield on the 2-year Treasury note rose more than 4 basis points to close at 4.27%, whilst the yield on the benchmark 10-year Treasury bond, which is used to price mortgages, auto loans, and credit card debt, jumped by nearly 5 basis points to settle at 4.71%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions. In the commodity markets, oil prices moved higher on Friday after Iran said it had attacked 2 oil tankers transiting through the Strait of Hormuz. The Islamic Revolutionary Guard said it hit the oil tankers as they attempted to cross the strait under U.S. military escort, and this action forced 4 other oil tankers to turn back. In response, the U.S. benchmark, that is West Texas Intermediate crude, rose more than 1% to close at $84.67 per barrel, whilst the international benchmark, Brent crude, also gained more than 1% to settle at $90.12 per barrel. For the week, oil prices surprisingly fell more than 5% on the back of a sell-off earlier in the week on Monday that was driven by hopes of de-escalation in the Middle East conflict. In the precious metals market, gold slid by 2% on Friday as the US dollar rebounded from a 1-month low, though the precious metal was still on track for its first monthly gain since February as weaker inflation data reduced expectations of further rate hikes by the Federal Reserve. The recent gains in gold have been driven by softer inflation data, which led traders to scale back expectations that the Federal Reserve would hike interest rates later this year, and as oil prices retreated earlier in the week on the hope of a de-escalation in the Middle East conflict. According to the CME's FedWatch tool, traders are now pricing in a 65% chance for a U.S. rate hike in September, compared to an 80% chance the previous week. Gold has gained by 0.5% in the month of July, which was its biggest monthly increase since February. And as at the closing bell on Friday, spot gold was down by 1.8% to settle at $4,027 per ounce. Up next is a quick review of the African financial markets, where data from Statistics South Africa showed that South Africa's producer inflation slowed to 7.5% year-on-year in the month of June, down from 7.8% in May, and came in below analyst expectations of 7.9%, with analysts attributing the slowdown to lower food and fuel prices. In response, the South African rand strengthened against a weaker US dollar on Thursday and was trading at 16.52 against the dollar, while the local market digested the lower than expected producer inflation data for fresh signals on Africa's most industrialized economy. We now change scene to the Kenyan financial markets. And we start by looking at the cost of living in Kenya, where according to data from the Kenya National Bureau of Statistics, Kenya's overall annual rate of inflation rose to 6.5% in the month of July, up from 6.4% in June, and was the second highest rate in over 2 years, and was mainly driven by elevated transport costs. This latest inflation reading was just slightly below the 6.7% recorded in May, which was the highest rate since January 2024, highlighting the wave of price pressures that began after the Middle East conflict pushed up global oil prices. The data shows that transport remained the biggest driver of inflation, with prices in the sector rising by 15.6% over the past 1 year. The increase in transport costs coincided with a spike in global crude oil prices following the US-Israel war against Iran, which began in late February and whose effects finally reached Kenya in April through higher fuel prices. Meanwhile, core inflation, which excludes food and energy prices, this increased to 3.2%, up from 3.1% the previous month. However, non-core inflation, which focuses on food and energy prices, this declined to 15% in July, down from 15.1% in June 2026. In the domestic foreign exchange market, during the past week, the Kenya shilling remained range-bound versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.40, and this is compared to a rate of 129.53 that was recorded the previous week. Meanwhile, the sterling pound was priced at 171.99, and the euro was valued at 147.39. And on the regional front, one Kenyan shilling was changing hands for 28.86 Ugandan shillings and 20.36 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.34. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, And this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 70% of total budgetary allocations. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves recorded a significant increase of more than $1.5 billion for a grand total of $15.4 billion, which is equivalent to 6.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. This massive increase in forex reserves was attributed to two main sources, the first being the receipt of funds for the sale of a 15% stake in Safaricom to Vodacom, and the second is the recent disbursement of $750 million from the World Bank that is aimed at economic and fiscal reforms. However, despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024, with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet demand for overnight lending and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this amount averaged at 13.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 30th of July, and the central bank received bids totaling to 27.3 billion shillings against an advertised amount of 28 billion shillings, representing a performance rate of about 98%. The central bank accepted 27.2 billion shillings, and the results of the auction were as follows. The 91-day rate was stable at 8.78%, whilst the 182-day rate remained unchanged at 8.95%, and the 364-day rate dipped by about 2 basis points to settle at 9.01%. Over the past few weeks, the Treasury yield curve has been stabilizing with interest rates clustering around the 9% level. However, there is still the possibility of higher interest rates driven by increased government borrowing as the Treasury seeks to plug a budget deficit of about 1.2 trillion shillings for the current fiscal year 2026-2027. In addition to that, the escalating conflict in the Middle East is once again pushing up oil prices, and as a result, we can expect inflationary pressures to pick up, and this will eventually feed into higher interest rates as the central bank endeavors to keep inflation expectations well anchored. As a consequence, we should therefore expect more upward pressure on interest rates in the short term as investors demand higher yields in order to offset the impact of inflation. In the primary bond market, the Central Bank of Kenya has published a prospectus and is now inviting bids for not one and not two, but 3 reopened infrastructure bonds in which it is looking to raise an astronomical amount of 150 billion shillings. The following are the details of the infrastructure bonds that are on offer. The first bond is a 16-year bond that was initially issued in 2019 and now has 9.3 years left to maturity. This bond matures in October 2035 with a 50% amortization in October 2030 and a coupon rate of 11.75%. The second bond is an 18-year bond that was initially issued in 2021 and now has 12.7 years left to maturity. This bond matures in March 2039 with a 50% amortization in April 2030 and a coupon rate of 12.66%. And the third bond is a 21-year bond that was initially issued in 2021 and now has 16.2 years left to maturity. This bond matures in August 2042 with a 50% amortization in September 2031 and a coupon rate of 12.73%. These bonds are now open for sale until Wednesday, the 12th of August, when the auction will be held. Please note that the interest earned on infrastructure bonds is exempt from withholding tax. Up next is our topical issue, and this week we're looking at the latest developments in the domestic crypto market. There were 2 major headlines on crypto this past week, and at face value they appear to be pulling in opposite directions, but it turns out to be a delicate balancing act by the National Treasury. We start with the good news for the crypto sector, as the Treasury has slashed the minimum paid-up capital requirement by up to 40%, meaning that stablecoin issuers will now only need to post 300 million shillings instead of the originally proposed amount of 500 million shillings. The reduction in the capital requirement was in direct response to pressure from the Virtual Assets Association of Kenya, who argued that the original amount would have locked out many legitimate players before the industry has even started operating. Additionally, liquid capital requirements also came down, but the annual license fee remains at 2 million shillings. And now for the bad news, because in the same set of rules, the Treasury has banned interest payments on stablecoins, regardless of how long the investor holds on to them. So why does this matter? Because in contrast to other markets like the United States, stablecoin issuers do in fact pay interest through processes such as staking and lending. However, in this regard, Kenya has opted to take a different route, and this decision is mainly driven by concerns that if dollar-pegged stablecoins start paying better interest than what commercial banks are offering for your standard bank account, then it's highly likely that depositors will pull their money out of banks, and this could lead to a run on bank deposits and destabilize the domestic financial markets. So, combining the two pieces of legislation, we can see the Treasury is trying to manage a delicate balancing act where, on the one hand, it is willing to open the Kenyan markets to crypto investors, but on the other hand, it has a responsibility to ensure the stability of the domestic financial markets by safeguarding the banking sector from external and unnecessary competition for deposits. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them posted on the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the future belongs to those who believe in the beauty of their dreams. A quote by Eleanor Roosevelt. Think about it. Thank you, and God bless.